recession and Indian elusive chase for black money. काला धन को वापस लाने के नाम पे जो लोगों के ऊपर एक बहुत फाइनल एक फरमाई तोहफा दी गवर्नमेंट ने, उसके बारे में उनका एक किताब है। और मैं डॉक्टर आर रामकुमार को लीड करता हूँ आप लोग की तरफ से।
Banking industry, honorable leaders of the banking movement on the dais, friends, it's a great pleasure for me to greet you on the occasion of the 16th All India Conference of the Canara Bank Staff Union, and I'm very privileged that you invited me to speak to you on this occasion. I've always, I've never sort of said no to an invitation from bank employees unions. And the one reason why I do so is that and the one reason I've never said no, apart from the fact that many of them are my friends, is the fact that I always held the role of bank employees unions in the struggle against neoliberalism, the struggle against policies of liberalization, etc., as very paramount. I think the role of banks in the Indian economy, the stability of the Indian economy, in ensuring its growth, development, etc., is very significant. And all of you know that in times of great crisis, may it be the 2007 financial crisis that the world faced, or the demonetization, which was a man-made crisis in 2016, or the COVID crisis in 2020 and after, you will see that public banks have played a stellar role in ensuring that relief reaches people, ensuring that stability is ensured in the macroeconomy, and we do not have major banking crises like we saw in the developed countries of the West. And that role could be played by public banks on occasions like this because public banks survive the onslaught of privatization and liberalization. And if public banks survive the onslaught of liberalization and privatization, it is primarily because of the historic resistance waged by bank employees unions for the last 20 to 30 years. So I must begin by saluting your commitment to keep this sector in the public sector, in the public domain, which has ensured that there is some sort of stability in the Indian economy, and like other Western capitalist economies where private sector banking is predominant over public sector banking. So it's very important to remember that. So that's one reason why I never evade a chance to speak on these occasions. We all know, I mean, I was asking the comrades on the dais what I should be speaking on. They said economy and banking. So I said economy and banking, or banking and the economy. So I said both are the same. I said no, well, both can be the same, but both can also be different. You can also, it depends on what you focus on. So what I'm going to do today is to keep the economy in the background and keep banking on the foreground. I can also do the reverse if that's what it is, but I'll to sort of keep some sort of logic in the presentation. I'll do the earlier one. So the history of banking is well known to you in India. In fact, if there is a progressive history of banking in India, that primarily begins in 1969 when banks were nationalized in India. That's the time when a predominantly private sector of banking was converted into a predominantly public sector of banking. Prior to 1969, if you see the numbers that are available with us, from the early 1950s to the late 1960s, the private sector banking was pushing India to the brink of an economic crisis. Planning had largely failed, and the inability of banks to respond to the development needs of the economy was an important factor. Large number of private bank branches were regularly closing down. The deposit base of the economy was very small. Banks were simply absent in the rural areas. They were primarily an urban or metropolitan presence. And most of the loans given by banks were primarily industrial in nature. And they had absolutely no presence in the rural areas, or they had only about 10 to 15% of the total loan portfolio was given to farmers or rural areas in India. Why was this the case? This was the case also primarily because these banks were owned by the very same private capitalists to which industrial loans were being given at that time. So you had a strange situation at that time. Industrialists owned banks, and industrialists also got most of the credit from the banks. Basically, most of the loans given to industrialists were the deposits that were mobilized by the same banks. So it basically was public money collected by the banks and passed on to private hands through the banking system as an intermediary. This was not just inefficient but also highly corrupt, because the same industrialists who took the loan, took deposits from the people, converted it to loans on the other side, never repaid that loan, and as a result the banks collapsed on a regular basis. Large number of bank branches closed down and banking sector turned into a field of crisis. This also meant that the role of banking, the role of credit in creating growth in the economy was very weak at that point. So all these were reasons why the nationalization of banking was thought about in 1969. Now, this nationalization of the banking, what did it do? It basically asked banks to go to rural areas, to spread out, to give loans to more number of people. What does that mean? It means that if you have to open one urban branch or one metropolitan branch, you have to compulsorily open 4 rural branches. And otherwise you will not be able to open that urban branch. Which meant that if in 1969 you had only 1,500 rural bank branches in India, by about 1991 that 1,500 had become 35,000. That was the extraordinary spread of banking that you saw between 1969 and 1991. Second, the priority sector guidelines came, which meant that 40% of your credit had to be given to the priority sector. Out of that, 18% has to be given to agriculture. All of these things you know more than me. So this meant that not just bank branches were opened, but also large amounts of credit were actually going into the rural areas, which were earlier collected as deposits. So banks played a very important role here. It collected huge amounts of deposits and it made available to potential investors on the other side as investment credit. This means that financial intermediation, which is a very important role that banks play historically, grew enormously during this period. There were also other things, differential interest rate scheme, etc., where agriculture and other activities received loans at a lower interest rate compared to industry and so on. So essentially, there was a revolution in banking in India after 1969, which is essentially what we call as the period of social and developmental banking. Social and developmental banking means you consider banking as having a social purpose. Social purpose in the sense, if you are engaging with a consumer, you don't necessarily look at whether that transaction will lead to a profit or loss. You consider it as your social responsibility to engage with that customer. But
In the other case that I will refer to soon after, it is the opposite of this. You will engage only if there is a profit. That is the opposite of this, which is the period which came later. But in this period, the social purpose of banking was served by nationalization. And that is essentially something that supported a huge change in rural areas called Green Revolution. Green Revolution needed new seeds, new fertilizers, other inputs, etc., for which farmers needed working capital. And this working capital had to be given by somebody. Earlier it was given by moneylenders, usurers, saukars, etc. And that role was now substituted by public banks, which meant that interest rates came down from about 60% to 120% per year to about 8, 9 or 10% per year, which has come down even further now, but that's a different matter. Now, this meant that banking sector gave a huge boost to Green Revolution in India. On the other hand, what happened? You also had other banking institutions that came up. Long-term lending institutions, which are essentially developmental finance institutions, DFIs. IDBI was an example. IDBI at that time did not take short-term deposits, or many of you will know. IDBI only mobilized money from the market and made it available for long-term credit to investors. So this differential was maintained between those banks, SBI, Canara Bank, etc., which will take short-term deposits and give short-term loans, and other developmental financial institutions like IDBI, which would essentially mobilize in the long term and also give out credit in the long term. So there was a balance in the banking system whereby you either took short-term deposits and gave short-term loans, or you take long-term, you mobilize long-term funds and give it in long-term loans. This was also something that gave a boost to industrialization. So agriculture benefited, industry also benefited from this. So essentially, that is why it is important to understand the 1969 nationalization as a revolution in Indian banking. Revolution in the sense that it brought about a period of social and developmental banking, which gave a boost to both agriculture and industry. But there were people who did not like it. There were people who did not like it in the sense, two people went to the Supreme Court and filed a case saying that bank nationalization was unconstitutional. And who were these two people? Number one, Mr. Minu Masani. Minu Masani was a leader of the Swatantra Party at that time, which had always, from the time of Rajagopalachari in its previous avatar, had argued for free market economy in India, right from independence time. That is all. But the second person is more interesting. The second person's name is Balraj Madhok. Who was Balraj Madhok? A leader of the Janasangh at that point of time and the political mentor of Atal Bihari Vajpayee. Two people went to the Supreme Court. So, you can see where the allegiances of different sections of the Indian political system lay at that point of time. Minu Masani of the extreme right wing in economics and Balraj Madhok of the extreme right wing in cultural politics both went to the Supreme Court questioning nationalization and argued that it was unconstitutional. In 1972, the Supreme Court struck that case down and said it is constitutional, there is no problem. But I'll come back to this political point a little later when we discuss the contemporary policies of the Union government and why they very neatly fit in both in 1969 and in 2022. Now, let's continue. Now, this essentially then was a period where monetary policy, so the bank nationalization period, was a period where monetary policy was being used as an instrument for redistribution and growth and development in the economy. That is a key point. A lot of people opposed it. I'm an economist, so a lot of economists of the free market persuasion argued that this policy is wrong. Why this policy is wrong? They said this creates financial repression, they said. Financial repression means what? You create a ceiling for interest rates. That's what you do. You administer interest rates, right? You have a base rate, you have a maximum ceiling on interest rates, etc. That kind of a ceiling on interest rates will reduce savings rate in the economy, will reduce investment rate in the economy. That was the argument made by a lot of free market economies at that point of time. But India's nationalization showed that that theory, which exists only in textbooks, is completely wrong. In fact, quite to the contrary, the time of financial repression in India was the time when savings rate rose between 1969 and 1991. Investment rate rose from 1969 to 1991, and that's how it aided agriculture and industry, as I mentioned a little while back. So this meant that banking was a very important component of how India grew and developed in this period between 1969 and 1991. Come 1991, policies changed. The World Bank, IMF, etc. came and imposed conditionalities on the loans that they gave to the Indian government in 1991 and said, one of the things that you have to do, which is what we tell countries across the world as part of what is called as the Washington Consensus. The Washington Consensus is that whenever a country is in economic or financial crisis, the World Bank and the IMF will go and say, we will give you a loan, but if you want this loan, you will also have to implement a set of conditionalities. And one of those conditionalities, which is the whole thing is called Washington Consensus, because it is prepared in Washington for obvious reasons. This essentially meant that one of the components of Washington Consensus was financial liberalization. And as part of financial liberalization, the key component was privatization of banking. Now, a moment must be taken to explain the context behind this. What is this? I mentioned two terms earlier. One is monetary policy and the other is financial repression. And I mentioned earlier that both these were proven wrong. But these same theories which were proven wrong were brought back in 1991 to argue for financial liberalization. They said financial repression in India is creating a compression, a depression of savings rate and investment rates, and as a result, we should remove all administered interest rates, free interest rates of all regulations of RBI and government, etc. And if you free interest rates of all regulations of the government and the RBI, then our savings rate will rise, investment rate will rise, and so we need financial liberalization. That was the first argument that they put forward. The second argument that they put forward was that monetary policy should not be used for the purpose of growth, development, or redistribution in the economy. Monetary policy's sole purpose is to control inflation. So the only role of the monetary policy is to reduce inflation and keep it in a band of 4%, 5%, whatever it is fixed in each country. If you want to redistribute assets in the economy, if you want to create growth, etc. in the economy, that is not the role of the monetary policy, that is actually the role of the fiscal policy. You do it in the budget, not through banks. That was the argument that was put forward at that time by none other than Mr. Narasimham, who authored the Narasimham Committee in 1991. So this essentially meant that the idea of the argument of financial repression and the idea that monetary policy should be disconnected from any goals of redistribution in the economy were the driving ideological motivations behind financial liberalization in India. So financial liberalization began. And what happened under financial liberalization? That 4:1 policy, where to open one urban branch, you had to open 4 rural branches, was struck down. And then priority sector regulations were diluted. Nobody had the guts to remove priority sector altogether. It was like a political hot potato at that time. So what they did was they filled priority sector with all non-priority elements. So for example, I work in agriculture, so I can give you an example from agriculture. So the idea of agricultural credit was completely diluted after 1991. Earlier, indirect finance was not part of priority sector. After 93-94, indirect credit, which is mostly given to private companies, corporates, etc. Direct finance and indirect finance are separated in banking. The indirect finance came to be considered as part of the priority sector. Number 2, if you are giving a loan to Pepsi for a Lay's chips factory, the Lay's chips that we eat for 10 rupees packet, that chips factory, if Pepsi is setting up that chips factory and gets about 300 crore as loan to set up that factory, that 300 crore can now be considered as agricultural credit. Why? Chips is made of potato is made by farmer is in agriculture, and hence, same. Right? So that 300 crore now immediately gets classified in the books of the banks as agricultural credit. So all the, I'm not and also a lot of undue increases in credit limits took place from the late 90s onwards. Huge increases, pesticide dealers, fertilizer dealers, all of them got from 5 lakh credit limit was increased to 30 lakh credit limit and so on. Huge credit limits rose under indirect finance and so on. All those changes took place. So essentially priority sector regulations were diluted, and that had the same impact as closing down branches. Right? And then differential interest rates schemes, etc., were also diluted and disbanded over a period of time. So essentially, whatever were the key features of the nationalization of 1969, all of them were undone by the reform of 1991. The impacts were very clear. Between 1995 and 2005, I'll give you a 10-year period, about 1,000 rural bank branches closed down in India. In the 1990s, the growth of agricultural credit per annum was about 2%, whereas it was 6% in the 1980s decade. It fell to 2%. Right? Large numbers of Dalits, Adivasis, farmers, women, etc. were excluded from the ambit of rural credit because now banks were told that social and developmental banking is not your core functioning principle, it is commercial banking. Commercial banking in the sense, profits are the center of your operations, not whether you're doing it, whether you are fulfilling a social purpose or not. The question is whether you are making a profit or not. So when profit became the underlying principle of banking, then all the social purpose of banking got diluted, and essentially banks moved away from people. And this is the area where bank employees unions have waged historic struggles to protect banking, not to allow this to happen, to keep banking closer to people, to keep the relationship between banking and the economy intact. This has been the focus of most of the struggles that banking unions have, staff, officers unions have undertaken over the last 20 to 30 years. So this became a very important point in the 1990s onwards. Now let me take a step back and go to my context, which is the economy, right? And I'll come back to banking after I provide that context. If you look at the period after 1991, the liberalization of the economy, there are 3 phases of economic growth that you will see. There is a broad period between 1991 and 2002. And then there is a period between 2003 and 2011. And then there is a period between 2011 and COVID. Right? The last 10 years. So there are 3 phases you can see. Essentially it's 90s, 2000s and 2010s, the 3 decades after 1991. What happened in 1991? The overall growth rate of the economy in the period of the 1990s was about 6.1%. Was it higher than the period of the 1980s? Hardly. Because in India, what is important to note is in the 1950s, 1960s, 1970s, etc., our growth rate was largely about 3% per annum. 3% per year, on an average. That's why people made fun of it from the US, West, and so on, that you are having a Hindu growth rate. By Hindu growth rate, primarily because Hindu society is supposed to be unchanged for generations and generations or centuries in the past. It's also a faulty point. But essentially there is a Eurocentric view that Hindu societies are static. And hence this 3% was considered a static, constant, unchanging growth rate that you had for 3 decades. So India was made fun of in the West as having a Hindu growth. So 3% was the average growth rate of the 1950s, 1960s and 1970s. But in 1980s this changed. Our growth rate picked up. And became 5.6, 5.7% per annum. So by the 1980s itself, India had escaped the so-called Hindu growth rate of the 50s, 60s and 70s and raised its growth rate to about 5.5%. That's a significant achievement prior to liberalization. So it is completely wrong to argue that it was liberalization, as some people argue in newspapers and so on. It was liberalization which rescued Indian economy from the Hindu growth rate. No, completely wrong. From the 1980s itself, India had begun to grow at 5.6% per annum. And that increased to only 0.5%, by 0.5% to 6.1, 6.2% in the 1990s, not more than that. And in the 1990s, you saw enormous losses. Banks closed down in the rural areas. Agricultural credit and rural credit, etc., crashed in terms of growth rates. Or priority sector guidelines were being diluted. For the first time after 1969, the moneylender was coming back into the rural economy. The Sahukar was returning to the rural economy. So All India Debt and Investment Survey is there, which is a government survey, which essentially shows that if in 1991, out of 100 rupees which were borrowed by a rural borrower, 17 rupees was given by a moneylender, that in 20 years became 33 rupees. If the moneylender was giving 17 rupees out of the 100 rupees of debt of a rural borrower, in about 20 years, that had risen to 33 rupees per 100 rupees, doubled. This is only the moneylender. Other traders, etc., are different. So if you add all that, essentially the informal sector was returning to the countryside. The informal sector was coming back to the country, and that is primarily because banks lost sight of the social purpose that I was mentioning. Commercial lending became the core functioning idea, principle of the banking sector. It was still public. Only very few banks were being privatized. It was still public. But the very idea of public sector was being diluted. The very idea of public sector was being weakened by ensuring that these regulations move the banking sector away and away from people, away and away from the economy. Now this 90s period was followed by the 2000s. But in 2000s, the situation changed. A lot of things were changing globally, because in the United States, for example, Bill Clinton came in 93, 94 and so on, and essentially he thought that the preceding period, the Reagan period, was marked by very high rates of interest, etc. So he lowered interest rates and so on. When he lowered interest rates, overall growth picked up in the US economy. Number two, capital started to move from areas of low interest rate to areas of higher interest rate, which means that enormous capital flights took place to countries like India. So countries like India were suddenly flush with enormous amount of foreign capital. And that was also the time it had opened its stock market. So money was flowing in huge amounts. This is also the time agricultural prices across the world began to rise, because overall global demand was picking up, global economic growth was happening, global demand was picking up, agricultural prices began to rise. So countries like India could export more to the world, and these higher agricultural prices were reflected in the Indian domestic market as higher domestic agricultural prices also, which benefited farmers, which meant that agricultural growth also picked up in the 2000s, second period that I am talking about. And then this is also the time when we opened up our IT sector, right? IT sector picked up in the sense that there was changes in the rules in the developed countries as to how outsourcing can be done and so on. So there was a huge increase or expansion of back office operations of companies headquartered in the West, which meant that a lot of BPOs, etc., opened in countries like India. So India's software exports, services exports began to rise during this period. So it was like a dream period. One economist calls it a dream run. Right? So the 2000s, we saw the growth rate of 8%, 9% per annum. You may remember 10 years back, India used to take a lot of pride in this rise of growth rates to 8%, 9%, etc. That is because of all these all these favorable, positive factors coming together and creating some kind of growth. But this growth had a problem. This growth had a problem because it was largely also financed by credit, debt. I'm talking about prior to 2007 itself, this had happened. So a lot of changes that you see in the banking sector. So banks, so when all this money is coming into the banks, all this money is running to the stock markets on the other side, savings rate is rising. Savings rate is rising means banks are getting more and more deposits. Banks are sitting on enormous liquidity now. Right? And here is the problem that begins between banks and credit in a free market economy. Right? Essentially, what do banks do? Banks take deposits and give credit, and take an arbitrage gain from the big. You give depositors 7%, 8%. You won't give that now, but at that time, and then you give credit at 10%. So the difference is your profit, from which you meet your costs and margins. Right? This is essentially how banking functions. There's no other way banks can make profit. There's no other profit that banks can actually make. This means that if you are flush with liquidity, your losses will increase if you do not increase your credit. Because how you pay your interest rate to your depositors. Right? So in a period of rising liquidity, if banks do not push enough credit outside, then banking operations will be unviable. And that's exactly what happened during this period. Across the world, what happened was, there's a difference between across the world and India here. Across the world, what happened was, because banking was largely in the private sector, and they were functioning in markets which were completely liberalized financially, they were trying to push out credit in all kinds of shady instruments, derivatives, these new instruments of you basically bundle your risks, right? And you sell your risks to another company, and that company bundles many more risks and sells to yet another company, and that sort of cycle builds up. That kind of toxic build-up of vulnerabilities happened in the Western economies. But India was not like that. Here, banking was largely in the public sector. We were not allowing that kind of those kinds of links between Alan Greenspan in the US had already weakened many of the provisions of the Glass-Steagall Act of the 1930s, whereby the relationship between banks and financial markets had become closer in the US by the 90s. So all this created an explosion in the world financial markets, particularly in the US, etc. But in India, the character of this problem was different. Here we were largely in the public sector, but again, public sector was being pushed to make more and more profits in the period of financial liberalization. So essentially what the banks were being asked was to push your credit out, push your money out as credit. So banks moved into all kinds of people and gave all kinds of loans to all kinds of creditworthy and non-creditworthy borrowers. And then came 2007 crisis globally. And when the 2007 crisis came globally, it touched India also. And how did India respond? How did the world respond? The world responded by increasing public expenditure. A lot of countries used their fiscal policy, that is budgets, as an instrument to increase growth in the economy. India did that for a few years, from 2007, 8, 9, they tried to do that. But then India backed out and said, monetary policy will be the substitute for fiscal policy. Why? Fiscal policy means budgets. Budgets get money from taxes. If not taxes, you have to borrow. If you are an African country, you will get aid also. But let's leave that out of a country like India. You are essentially dependent on taxes or borrowings. Now, if you increase your taxes, your capitalists will be upset. That was the time. If you see the period of liberalization from Chidambaram onwards, Manmohan Singh onwards, when Manmohan Singh was there, the corporate tax rate was 45%. Yesterday, Nirmala Sitharaman was responding to Chidambaram by telling Chidambaram, why are you telling me that I am giving so much benefits to corporates? It was started by you. And she was right. Both have done that. Right? So 45% was the corporate tax rate in early 1990s. That first became 40%, then that became 35%, then that became 33% with surcharges and so on, right? And now, what Nirmala Sitharaman has done has brought it down to 25%. So, both are sitting in the same boat, right? But are blaming each other. You did first, I did first, you did first. So that blame game is going on between these two parties, but essentially both of them were complicit in ensuring that our corporate tax rates are one of the lowest in the world. So there are no taxes. Right? Now, what is the other option? Borrowing. Now, borrowing means your fiscal deficit will go up. Now, here there is another problem. If your fiscal deficit goes up, you are in a world where capital is mobile. Capital flows from one country to another freely, because everybody has liberalized their financial sectors. As a result, when capital moves freely from one country to another, what principle does finance capital adopt to decide on which country to go to? profit. But profits are backed up by a sense of security of their investment. Right? So there is this sense among corporate, international corporate investors, financial investors, that those countries where there is less government intervention, that means government borrows less and spends in the economy, government taxes people less, etc., is actually more stable. This ideological viewpoint of finance capital essentially means that finance capital looks for stability when it decides to move from place A to place B, and one of the core variables that it considers when it considers that movement is how much is the fiscal deficit. If fiscal deficit is high, finance capital is hesitant to move into that economy because it is considered to be unstable. And if the government of that country is very eager to invite more and more foreign capital, more and more institutional investment into your economy, then it has now an incentive, a vulgar one though, an incentive to keep the fiscal deficit low. Because the moment it borrows, the fiscal deficit will go up, and then this will disincentivize finance capital to come to your country. That they're not ready to do that. So to keep finance capital happy, to keep finance capital incentivized to come to your country, you keep your fiscal deficits low. That means you don't borrow. So you neither tax nor borrow. Then how will you spend? You won't spend. You cut spending. And when you cut spending, what will happen? In a country like India, demand, which is very important, because people will spend only when there is money in their pockets. Right? And if people don't spend money from their pockets and buy goods, there's no demand in the economy. So if the government does not spend, particularly when the economy is doing badly, if the government does not spend and revive the economy or pump prime the economy through a counter-cyclical fiscal policy, then growth will remain subdued, growth will remain low, the slowdown will remain longer. To come out of this dilemma, the governments at that time, both of the Congress and the BJP, after the global financial crisis of 2007, said, okay, if we can't raise taxes because we have a financial crisis and so on, we will not raise taxes, we are actually reducing taxes. And we consider that a good thing. So that's ruled out. The second option is borrowing. If we borrow, then fiscal deficit will rise, finance capital will be unhappy and will be worse off. So we will not do that. We will ask banks then to give more and more credit. So banking sector was seen as a substitute for fiscal policy. So banks were asked, both by Chidambaram and by Arun Jaitley and by Nirmala Sitharaman, there is no difference between any of those things. Right? All of them asked banks to give more and more credit outside. And this is the beginning of the so-called NPA crisis that we speak about. Now, this essentially meant that banks are pushing in more and more credit to all kinds of borrowers, creditworthy and non-creditworthy. The share of non-creditworthy borrowers were rising. Right? The share of personal loans were rising, home loans were rising, vehicle loans were rising. How will people repay all these loans? People will repay all these loans only if there's some kind of return to them. But if employment is falling, I'll come to that in a while, how will people repay? If wages are not rising, how will people repay? So default rates will rise. There was one more thing that happened in the beginning. And what was that? I said that when we nationalized, when I gave the agriculture, industry, green revolution, etc., that example, I said that there were two types of banks. SBI, Canara Bank type of banks and IDBI type of banks. But under financial liberalization, there was an additional argument which was put forward, which said we should now have universal banking. Notice universal banking, there is no difference between SBI, Canara Bank and IDBI Bank. All do the same thing. So, SBI will take short-term deposits and give long-term loans, and IDBI will take short-term deposits and give both short-term and long-term loans to them. So the whole difference between these two types of banking systems, that means developmental finance as a concept was diluted, weakened, and universal banking was brought in. Nobody does universal banking with it. Even capitalist countries have their strong developmental finance institutions. Germany, China, you look at both socialist and the capitalist worlds, you will see extraordinary presence of developmental financial institutions. There, your ordinary bank doesn't give loans to Vijay Mallya, or Nirav Modi, or Mehul Choksi. Here what happened is SBI, Canara Bank, I don't know Canara Bank gave, but Punjab National, all of them gave loans to these Vijay Mallyas, SR, Vijay Mallya, what is the gem company? Your favorite gem? Some 8,000 crore they have to repay. There's some gem company, gems, Gitanjali Gems company. Earlier, SBI never used to give to Gitanjali Gems company and all that. But now, that's also, so it's not, SR's loan at some point of time was about 40,000 crore. They repaid part of it now, but the number was very high. And now the golden boy of the economy is leveraging 83,000 crore from the Indian banking sector. The name golden boy is enough, isn't it? That's not required. There's only one golden boy. Right? So he's having 83,000, I don't know the exact number, but close to that number, 60 or 80,000 crore is the amount that person has got. Right? Which means that you basically are sitting on short-term deposits, which is a liability to you, because you have to, when they tomorrow come and ask for that money, you have to give. It's a liability. And what's your asset? Your asset is long-term, but your liability is short-term. It's a recipe for crisis. Right? So the finance, the whole period from 2007 onwards that you see is the time when banks are asked to substitute for fiscal policy, number one. We cannot tax, we cannot borrow, so you give your loans, number one. Number two, the protective cover that they had of short-term, and long-term, that kind of protective cover that they had in the past had by now disappeared. Now, does it IDBI take short-term deposits? IDBI Bank is now IDBI Bank. It takes short-term deposits. I can go and have a deposit in IDBI Bank, isn't it? Yes. That was not possible earlier. Now it's possible. So that difference has collapsed. Right? So essentially, both the idea that monetary policy will substitute for fiscal policy and the idea that we will be having universal banking and collapse long-term and short-term into one entity, whereby you are exploding the risks in the sector. Risks explode because if one Vijay Mallya does not repay 8,000 crore rupees, then all your short-term deposits are in trouble. Tomorrow if they come and ask for the money back, you cannot give because Vijay Mallya has taken it away. Vijay Mallya is a metaphor, but the idea is to mean long-term credit on the other side. Right? This meant that risks in the banking sector increased, and there is no wonder that NPAs were going to increase also. But NPAs increased for one more reason. Despite all this, the third phase of the economy picked up. 90s I said, then 2000s I said, 8%, 9% growth rate, then comes 2011. All the positive factors that Indian economy had in the 2000s decade disappeared. What is it? Number one, finance capital was flowing into your country. That slowed down. Global demand was falling, so agricultural prices were falling. Global demand for Indian exports were falling. Right? And all this happened alongside the fact that the global economy was slowing down, and because the economies across the world were integrated very closely now, economic growth rates in India were also going to slow down. So if you see from 2011 on, a lot of people say that the economic slowdown in India is more recent. It's not correct. If you look at the data, you will see that from 2011 onwards, when the third phase starts, Indian economy has begun to slow down. What are the indicators that you have to argue so? One, your savings rate. your savings rate actually fell from, where is my number? Yeah, the savings rate fell from 37% in 2011 to 31% in 2016, and then to 30% by 2019-20. So that means 7% of the GDP is a loss in savings rate. Right? Investment rate fell from 40% in 2011 to 32% in 2016 and 31% in 2019-20. So savings rate is falling, investment rate is also falling. Why did I say 2016? Because a lot of people argue that it is after 2016 when that big thing, when that very intelligent move was initiated by the government of India. 2016 is enough. People now understand. Right? Don't need to say demonetization. That stupidest policy ever in independent India. If there is an award for the most irrational policy, the most stupid policy ever undertaken in independent India, that award undoubtedly belongs to Notebandi. 2016. Right? A lot of people say that is when the slowdown started. No, from 2011 itself, the slowdown had started. Savings rate fell, investment rate fell, exports to GDP ratio fell because global demand was subdued. There was nothing to export. I mean, there's something to export, but growth rate of exports were falling, and then exports to GDP ratio was falling. So your export to GDP ratio at that point of time fell from about 16 or 17% in 2011 to 12% in 2016 and 11% in 2019. So that's also falling. Then comes your area, bank credit. Right? Bank credit, the monthly growth rate of domestic bank credit was 27% in 2009. 27% monthly growth rate, right, was there in bank credit in 2009. But by 2015, that 27% had fallen to 6%. Right? And in March 2020, just as the pandemic started, we were still at 7%. And there were many quarters where the growth rate was negative. So, savings rate falls, investment rate falls, all this is pre-COVID. COVID is like picture abhi baki hai, right? We are just reached interval now, right? So, savings rate has fallen, investment rate has fallen, exports to GDP ratio has fallen, bank credit has fallen. And this affected people immediately. How? Two indicators are important: poverty, unemployment. What is the level of poverty in India? If you look at the level of poverty in India, you will see that the 2011-12 numbers were actually 21.9% share of people living in poverty. That 21.9% rose to 23% in 2017-18. 2% increase in absolute income poverty. Why is this a historic achievement? This is a historic achievement because, don't get me wrong, I'm being sarcastic. It's a historic achievement because after 1972-73, there was not a single period in India where absolute poverty increased. After 1972-73, there was not a single period in India that absolute poverty increased. The rate of decline was slowing down, off and on. But it was still falling. Right? But it never rose. And you saw that in the last year. Second, unemployment. It's become a cliche now that the unemployment rate, which was like 2%, 2.5%, was close to 7% by 2017-18, and it has risen further. Now, there's slight fall has happened, but it's still much higher than the 2.5% of 2011-12. And why is this another historic achievement? Because this is the highest unemployment rate in 45 years. That's why it's become a cliche. A lot of people say this, right? So I'm also saying this. So it is the highest unemployment rate in 45 years. So income poverty rose, unemployment rose. And that's obvious. It's primarily because the economy was slowing down tremendously during this period. Savings were falling, investment was falling, exports were falling, bank credit was falling, and obviously poverty will rise and unemployment will rise. And employment will rise only if investment happens to the economy. If investment is falling by about 7% of the GDP, 7% of the GDP means 200 lakh crore is the size of the GDP. Uska 7% is huge. That's a fall of investment. How many jobs would have been lost? How much of wages would have been lost? And is there any surprise that poverty rose? There's no surprise. It's obvious it will. It's common sense. So this is the time, this is the context of the last 10 years, essentially, between 2011 and just before COVID. Right? And this is the time when the two things that I said in the banking sector happen. Where you're pushing out more and more loans, you are substituting for fiscal policy, and plus you have become a universal banking country. So what was being a weak state turned into a crisis by the last 10 years. That is when you see this shooting up of NPAs in the banking sector. Who is responsible for the shooting up of NPAs in the economy? Undoubtedly, the government of India. Both Congress and the BJP are equally responsible for the NPA crisis that banks have faced, because it is an outcome of the distortions in the financial market, banking sector, created by the policies of financial liberalization in this country. Now this NPA rise is a result of government policy, but when the NPA crisis happened, what did the governments do? They were supposed to recapitalize the sector. They refused to recapitalize. Instead, they said these are inefficient institutions and we are going to sell them off. That is how the privatization agenda says. But is the inefficiency because of the banking sector? It was enforced on them, it was thrust on them by faulty, distorted government policy. So it is the government's responsibility to rescue banks and to keep them recapitalized. But they refuse to do so. Instead, what they do is now they are going to sell you off. Now the selling thing has a little history. If you look at the banking policy in India, you basically see from the 1990s onwards a slow creeping policy of liberalization and privatization. First you gave permission to large number of private banks. Then you gave a permission to a lot of NBFCs to convert themselves into banks. Right? Yes Bank, for example, is a classic example which is now in crisis. Right? ICICI Bank was a similar beneficiary of policy from the 90s, whose chairman and her husband are in jail now, yesterday. Right? The idea was that if private banks replace public banks, corporate governance will improve. That was the argument. Did it? You have to look at the jails now to see if corporate governance improved. There's no increase in corporate governance. The only thing that we see is corruption appears to have risen in the sector. And is there any major corruption allegation against any public sector bank in India? No. Because there are checks and balances in the public sector, which there is corruption in the public sector banking. You also know, I also know, but they are within a limit. There are checks and balances in the system which make it either visible, which make it possible to control them, which contain them, etc. All of that, it happens. There is no such check and balance in the private sector because the only consideration is protection of profit. If the public sector banking saw a dilution of the social purpose, in private sector banking there is the word social doesn't appear, because for a long period of time, now they have, for a long period of time, priority sector regulations were not applicable to these banks. Or if, forget the numbers now. If 40% of the priority sector were for public sector banks, it was 32% for private sector banks, and even lesser for foreign banks. I don't remember the numbers correctly, but I may be wrong, so pardon me for that number. But then certainly it was lower. Their social obligations were legally kept lower compared to public sector banks. So they would make, the rest is profits. So there were more avenues for profit making for private sector and less avenues for profit making for public sector banking, even when you said that the role of the public sector is to make profits. As the demonetization came, you asked banking employees to stay up till 12 o'clock in the night, come back at 6 a.m. in the morning. You squeezed the banking sector employees for your faulty policy. Everyone came and abused the government, but no government minister was there to hear the abuse. You people were there to hear the abuse, isn't it?
Yes. The bank employees.
Bank employees heard all the abuse on behalf of the political class. Right? And how did they repay you? Let's privatize. This is a betrayal of the government. I'm not pointing to one government. I was equally critical of both the Congress and the BJP in my presentation. But don't get me wrong there. Both have been equally culpable in pushing the economy to the present state of crisis and pushing the banking sector to the present level of crisis that they have. So this is the state we are in now. The banking sector is in a crisis, and that crisis is very difficult to ameliorate in the absence of an economic pickup. And the economic pickup is nowhere happening, and then COVID came. And COVID made a bad situation worse. The situation was already bad. The situation became really worse with COVID. We had 1 year of -9 to -10% growth rate. The next year it picks up, but it just only cancels out the minus. So essentially in about 2 or 3 years, your economy has grown only by 2%. If you look at the absolute numbers of the GDP. If in 3 years your economy grows only by 2%, what happened to employment in that economy? What happened to poverty in that economy? What happened to wages in that economy? It's easy to guess. Nobody, it's easy to, it's very amusing to see people being fooled by some of these numbers. Your GDP is 100 in year 1. Then you have a -10% growth rate. You reach 90, right? Now, if you have a +10% growth rate in the next year, you grow by 10% of 90, which is 9. You are at 99, not 100. You are 1 lower than 100, right? Even though you have 10, -10 and +10, you are still -1. Basic mathematics, class 5, class 6, class 7, right? But what is being told to us through the press? India has 10% growth rate. No, this is we live in a situation whereby even the normal things that the government does becomes a spectacle, right? And so -10 hoga, the next year will +10 hoga. When things become normal, it will become plus. But that -10 is forgotten, and only +10. It's as if you grew at 10% from 100, not 90. The reality is you did not grow at 10% from 100. You grew at 10% from 90, which means that you are still at 99. And the next year, if you grow at 3%, you are just above 100. That is why I said in 3 years, you grew only by 2 to 2.5% only. And what has happened during the COVID period? Jobs were lost, wages fell, poverty rose, hunger rose, malnourishment rose. All this happened, but the single group which was celebrating was the corporate sector. Why? For the first time after many years, the profit rates of the corporate sector grew. 85% of people in India suffered a fall of income during the pandemic. That's an Oxfam survey, right? But corporate profits increased during COVID. Quite a miracle indeed. But if you just scratch the surface, it's not a miracle. Why? Because companies were now employing much less number of people, so their wage bills are lower. Inflation had led to a rise in their output prices, so they were making huge profits as a result and paying less to their workers. Most of their workers are informal, unorganized. It is easy to send them away during the pandemic. So their wage bills really fell. Right? And then this rise of corporate profits at the expense of the majority of Indian population is now being celebrated as a sign of revival. It is hardly a revival. So where is the banking sector here? The banking sectors in such a market economy, the fortunes of the banking sector are closely linked to how the economy is performing. And if the economy is performing, you will have a fall of repayment rates, a rise of default rates, NPAs will rise, etc. All that is certainly going to happen. So the role of the government becomes even more important to protect the banking sector from collapse. For that, the government will have to correct its policies on the one side, and B, it has to recapitalize the banking sector to ensure that they survive this difficult time. But instead, what is the government doing? They have again identified a few more banks for privatization. Now, I think that I'm talking about the Central Bank of India, that 2-3 banks have been identified for merger with other institutions. That process is continuing. Too big to fail was what people thought before the 2007 financial crisis. People thought that big banks are actually good because big banks can never fail. They have enough leverage to survive. That theory was proven to be completely wrong by the 2007 financial crisis because it was the big who failed during the financial crisis. The too big to fail was completely proven wrong. But again, the government is sticking to that idea. We need big banks. We need a few big banks, not many small banks. So earlier you had State Bank of Travancore, State Bank of Mysore, etc. All of them were absorbed into State Bank of India. Why was State Bank of Travancore or State Bank of Mysore formed? Because they were sought to be catering to the local needs of the economy in those regions, and they had a local connection to those areas. So there was a decentralization of some sense happening there, where banks were responding to local needs, etc. Now you only want SBI. Right? It has no reason to respect the specific needs of a specific region which has specific needs. Right? That is one part of the story. The other part of the story is, if you are a big bank, are you sure that you will not fail? There is no surety, as 2007 showed. You will still fail if your policies are wrong and if your risks are exploding in the banking sector. So the role of the government here is clearly to protect the public banking sector, to recapitalize it, not to privatize it, to protect it, because you have to understand that it is the publicness, the public nature of the banking system which protected India from a collapse during the 2007 financial crisis and other such examples that came, and that publicness of the banking system must be protected. But the government does not appear to be in a mood to do that, and that is where the role of banking unions like yours becomes very paramount. Your struggles, your agitations, your movements to keep the banking sector in the public sector is not a trade union demand alone. It is a trade union demand, but it is not a trade union demand alone. It is a movement to protect India. It is a movement to create a stable economy in India. It is a movement to save India. And that must be the motivating factor in your future struggles. And I wish you all the luck. I salute you all for the struggles that you have undertaken in the past. And I hope that your struggles will find success, and it will ensure that the government realizes its errors and corrects it. But I can assure you that it's not going to be an easy battle. It's going to be a difficult battle, but I wish you all the luck. And I only can assure you that people like me who are outside, the common people, will be with you. We are in solidarity with you, and we will continue to stand with you in your historic struggle. Thank you.